It says that more than 95% of traders lose money trading in the markets. So what do the remaining 5% do to ensure that they are consistently profitable? Well, listen in today's video, I take you through 6 trading metrics which you need to track and tweak as part of your strategy to ensure that you become part of the profitable 5%, which is the top traders of this world. Let's deep dive. There are 6 elements to trading success. These are basically mathematical metrics which you can measure and tweak. And I learned this from the late Van Thapp, after I read his book, Trade Your Way to Financial Freedom. This video is broken down into 2 parts. I'll go through the introduction of these 6 concepts. Then in part 2, I'll deep dive into how they relate to each other. The first element that you need to track and tweak as part of your trading system is the reliability of your system. What do I mean by reliability? Reliability is basically what percentage of time do you make money. Is your win rate 60%? Is your win rate 50%? Is your win rate 40%? Now, one strange thing about trading, you might have a low winning rate, but overall, you're still profitable. How? That's where the second element comes in, your risk-reward ratio. Your risk-reward ratio is the relative size of your profits compared to your losses. For every dollar that you risk in the market, how much do you get in return? I usually recommend for beginners to target nothing below 1.5R. Usually you'd find most traders target around 2R. That's more of the midpoint. You'd find a lot of traders concentrate around that. If you can hit an R multiple of 3 consistently, then you are among the top traders. By consistently, I mean over a large sample size, 500 to 1,000 trades. If you do your average and your R is 3+, then you're a top trader. Very few traders are actually in that category where they can consistently hit 3R. The third element is your trading frequency. How often do you get the opportunity to trade? There are different types of traders, and ideally scalpers, day traders will have more opportunities to trade compared to swing traders and position traders. Now, having a high frequency doesn't necessarily translate to profits in the markets, especially if you're a beginner. Because if you cannot make 3 trades in a week successfully, what makes you think you'll be profitable taking 30 trades a week? You're just diluting the probability, and this will ideally affect your equity curve. If you've just started trading, aim for a rising low volatility equity curve. Don't look to take a lot of trades, just wait and be patient and take the right trades. The fourth metric is your trading cost. How much expenses do you incur for every trade you take? Expenses can be in the form of spreads and commissions that you pay to the broker. If you look at the different types of traders, ideally scalpers and day traders will have the highest expenses because they have the highest trading frequency. Yeah, because a scalper day trader is basically incurring the same spread as a swing trader. Over the long run, these costs eat into your profits, especially if you have a very low risk-reward ratio. You might end up net negative or break even over the long run just because of these costs. Costs are really important, and it's one thing you need to really track in order to become profitable in the market. The fifth element, a very important element, is capital. Capital is basically how much money do you have to trade the markets. I always say being underfunded is one of the biggest disadvantages that can face you as a trader. Nowadays, there are prop firms actually fund people from as low as $5,000 to as high as $300,000. You can take advantage of these prop firms because, and I want to give you an example, assuming you have 2 traders, one has $1,000 in trading capital and trader 2 has $100,000 in trading capital. Assuming they risk 1% and they target 2R as their multiple, the trader with $1,000 as his trading capital will be making $20 per trade, assuming it's profitable. The trader with $100,000 will be making $2,000 per trade, assuming it's profitable. Assuming their accuracy is 50%. These are basically the same traders, it's just that the differences are in their capital base. The trader with $1,000 in capital with a 50% win rate over the long run will be making $50 in 10 trades. Yeah. The trader B with $100,000 will be making $5,000. That's over a series of 10 trades. Trader B can ideally even pay his bills, meet his expenses. With trader A, you're making money, but it's not meaningful. Yeah, it's not commensurate to the time you're spending in the markets. And I always say, if you're underfunded, your time is better spent in other activities, which you can use to increase your skills to allow you to get more capital. If you have a 9 to 5, you can work to upskill, get more money in terms of a salary bump, so that you can have pump more capital into your trading account. Or if you have a small account, don't withdraw money, just build it consistently until the math makes sense. But making 20% on $1,000 account over 1 year, I mean, you spend too much effort to make that small amount of money compared to someone who makes the same percentage return in a $100,000 account. You're completely two different traders. One is able to meet the expenses and the trading makes sense to them, but one, it doesn't really make sense. That's why you see a lot of traders actually lose money, because you end up over leveraging and taking a lot of trades to make up for whatever you're missing in terms of cash returns from the market. The sixth element is your position sizing strategy. This is really important because it ties to risk management, and risk management is an important aspect of your trading arsenal. Position sizing is basically how you determine how much am I risking per trade, and other important metrics around things like your stop loss, your lot size. Yeah, your position sizing matrix determines how much you'll make in the market, how much you lose in the market. I'll deep dive into these in the part 2 of the video when I show you a concept called the risk of ruin. Now that we have looked at the definitions, let us see how these metrics actually correlate and work together. We start off with the relationship between the R per trade and the accuracy per trade. As you can see, profitability exists within a spectrum. This is something that I learned from Chris Capri of Second Skies Forex. You can fall within anywhere in this spectrum, from the negative end to the positive end. But the one area you need to avoid is the low accuracy, low R per trade. If in this area your strategy is not working, you need to stop trading and just reflect on what you can change about your trading strategy, because you know survive the markets in the long run. For the high accuracy, high R per trade, very few traders are here. If you're in this zone, you're basically an elite trader. Most traders will ideally be in the middle, yeah, where you have an accuracy that is more of midpoint, mid-range, and R that is more of mid-range, around 2R, and you're probably winning 50% to 30% of the time, between 30 and 50% of the time. So just a recap, you need to avoid the low accuracy, low R per trade systems and aim for more towards the high accuracy IR per trade trading systems that will keep you in the game for long. So how do you know that you have an edge in the market? Edge is measured by expectancy. And what exactly is expectancy? Expectancy is the amount you'd expect to gain or lose in your next trade. And to get to expectancy, you ideally need to know your accuracy and you need to know your average win per trade or loss per trade. Expectancy is dependent on your accuracy and the frequency that you trade. As you can see from the formula, expectancy, you take your percentage of winners, which is basically your accuracy, you multiply by your average win, then you less the percentage of losers in your account, and multiply that by the average loss per trade and divide that by the number of trades. Ideally, if your expectancy is positive, you have a positive edge, which means you'll make money in the markets in the long run. And to demonstrate this, I have 4 traders. These 4 traders have the 4 different trading styles. One is a day trader, the other one is a swing trader, I have a position trader, and I have a scalper. For these traders, I've assumed different metrics for the accuracy, average R, and expectancy. So for the day trader, I've assumed they're 60% accurate, and over the long run, they have an average R of 1. For the swing trader, I've assumed a 45% accuracy, over the long run, an average R of 2. For the position trader, I've assumed a 30% accuracy and an R of 3.75. For the scalper, I've assumed a 90% accuracy, but a very low average R, which is 0.15. And my belief is that these metrics are representative of what will be typically be found in the market. I've calculated the expectancy. For the day trader, he has a $20 expectancy. For the swing trader, $35. For the position trader, $47. And for the scalper, $3.5. What this means is, for the position trader, over the long run, they should expect to make $47 for every trade they take. So as long as they stay in the market, they'll always be making an average of or close to $47 for every trade that they take in the market. From an expectancy viewpoint, you can see that the position trader is making more money. If you just view it looking at the accuracy, the average R, and the expectancy, the position trader has the highest expectancy of 47, followed closely by the swing trader, then the day trader, and the scalper, as usual, expected to have a very low expectancy. Now, I want to introduce the concept of trading frequency and how it can impact your profits. So there are 2 more assumptions here. I've assumed that the day trader is making an average of 500 trades per day. The swing trader, ideally, I'd expect them to make less trades than the day trader, so I've assumed they're making 225 trades per day. The position trader, even less trades than the swing trader and the day trader. I've assumed they're making 150 trades per year. Sorry, the figures are per year. And then for the scalper, I've assumed they're making 1,200 trades per year. Multiplying the frequency with the expectancy, you can see the day trader is making $10,000 profits per year. The swing trader, $7,875. For the position trader, $7,050. And for the scalper, they're making $4,200. You can see how introducing the concept of frequency alters the math. When you looked at the expectancy figures alone, the position trader was on top with $47 expectancy. But once you factor in frequency, you can see the day trader is making more money. He is actually leading, followed by the swing trader, then the position trader, then the scalper making the least money. Now, don't look at the numbers at face value. Remember, there's a lot that goes on to trading here. Like for the day trader, he has to be content with making a lot of decisions, same as the scalper. Remember, for every trade you take, you're making more than 4 decisions. You have to make decisions around the entry, about the take profits, the position size, and the stop loss. And this is in addition to what you do before you even actually come into the conclusion that a trade is viable. So the day trader, this scalper, ideally need to have more mental fortitude compared to the swing trader and the position trader. So there are metrics, there are merits and demerits to each trading style, but I just wanted to show you how trade frequency can have a huge impact on your overall profitability as a trader. And this is how the 6 metrics actually combine to help you determine if you have an edge in the market. An important concept I'd like to close with, it's called the risk of ruin. What exactly is the risk of ruin? A quick Google search will show you a definition from Investopedia, which says the risk of ruin is a probability that an individual will lose substantial amounts of money through investing, trading, or gambling to the point where it's no longer possible to recover losses. From a trading point of view, risk of ruin is basically what's the probability that you lose a certain percentage of your account, yeah? And given everything that we've discussed, I thought it wise to actually end with this here, because your position sizing strategy can make or break your career as a trader. I've on my screen 2 examples. These are actually real accounts. From my 2 accounts, I no longer trade these accounts. These are just the past data from my FX book. And as you can see, my position sizing strategy was one which allowed me to stay in the market for long to realize the long-term expectancy of my system. For the first account, there was a 0.01 probability of losing 100% of my account. And for me to lose 100% of my account, it will take me 476 consecutive losses. My advice to you is your risk of ruin should always be 0, maximum 1. Always 0, maximum 1. As you can see from my accounts, for my account 2, there was I'd say 0% probability of me losing 100% of my account. For that to happen, it will mean losing 188 consecutive trades. Now, what is the probability of losing 10% of my account? For account 2, it was still 0. As you can see, my risk of ruin has always been 0 across. Yeah, and it will take 19 consecutive losses. It's rare to lose 19 consecutive losses. Same for account 1. It's rare to lose 48 trades in a row. So your position sizing system should be one that allows you to extract the long-term expectancy of your system over the long run. You want to make money in trading over the long run. Don't be short-sighted. Always look further ahead. 5 years from now, 10 years from now. You want to be milking the market based off the experience, because you put time to learn. Yeah, so there's no point of over leveraging and taking all these huge risks just to blow out your account. I want to show you an example of how to calculate risk of ruin. So let's look at that. There are 3 metrics you need to calculate your risk of ruin. One is your payoff ratio. This is basically your risk reward. How much money do you make for every dollar that you risk? 2 is your accuracy. What percentage of time do you make money in the market? And 3 is now more of your position sizing strategy. What percentage of your account do you risk per trade? So I have a trader, and I want to show you how these metrics are really important here. And as I said, you need to aim for a risk of ruin of 0 or maximum of 1. So I have a trader. Assume this trader risks 1% per trade, and they have a 40% accuracy. And they have a payoff ratio of 1.5. As you can see, their risk of ruin is 56%, meaning there's a 56% chance of this trader losing 100% of their account. Remember the 6 elements that I taught you? Now let us look if this trader decides to tweak 1 or 2, 3 things in the system, how it can affect the overall risk of ruin. Assuming the trader improves his payoff ratio to 2, as you can see, the risk of ruin goes to 0. So if you have a system where you risk 1% and you're accurate 40% of the time and your payoff ratio is 2, your risk of ruin is 0, which is a good place to be. But if your payoff ratio is 1.5, we saw that your risk of ruin goes to 56%. So this is how these 6 elements actually come into play. So you need to learn, what about my system do I need to tweak to turn me to overall level of profitability, especially in that break-even level. You've been there for long. What can you tweak? These are some of the things you can actually start looking into. What has been my average payoff ratio? How can I improve that? What's my trading accuracy? You cannot really improve your trading accuracy unless you do a lot of work around mental fortitude, work on your psychology, work on proper trading systems. So there's a lot that goes into that, yeah? Now, same trader who has a payoff ratio of 1.5 and an accuracy of 40, assuming they decide to lower the amount that they risk per trade to 0.5. Lowering it to 0.5 improves their risk of ruin, though it's still a worse scenario, but it has improved from 56 to 31.29. Yeah. What happens if they lower the risk of per trade further to 0.2? the risk of ruin changes to 5.48. Now, assuming a trader, and no most traders are greedy, you have this system and this trader decides to risk 5% of the account per trade. The risk of ruin matrix completely shifts. There's now an 89% chance that this trader will lose 100% of the account. Risk of ruin. Your risk of ruin matrix will help you determine if you have the proper position sizing strategy. And with that, ladies and gentlemen, I come to the conclusion of the video. I hope it has been of value to you. If you think it has been of value, please subscribe and hit the notification bell so that you can be notified every time I post a video.